If you're into investing, it's important to know that markets go through ups and downs all the time. There are times when things are great, bull markets, and times when they're not so great, bear markets. But here's the trick. You can still find ways to make money even when things are tough. It's normal to feel a bit nervous during tough times, but remember, it's all part of the game. So, use these market swings to your advantage. First, look for companies that are strong and have an edge over their competitors. But don't just rush in and buy whatever's popular. The market can be pretty crazy with lots of buying and selling happening every day. So, keep your cool and look for opportunities when others are panicking. That's how you can make some serious money in the long run. Business sense investing. When a company with a strong advantage is selling its stock at a price that promises a good return on investment, it's a good time to buy. Make sure to leave some extra room for unexpected events when deciding on the price. Keep an eye out for times when the market reacts too strongly to short-term news, like when a company's future earnings disappoint or when there's negative economic news. These situations often repeat themselves and can lead to stock prices dropping. By paying attention to these patterns, you can find good buying opportunities for solid investments. Market cycle positioning. The market cycle is influenced by a few key factors. Economic ups and downs affect investment trends. Investors' emotions often lead to overreactions. Risk can seem small one moment and big the next. Market prices sometimes focus too much on the good or the bad. It's important to understand these factors and use them to predict where the market is headed. Then, make smart investment choices based on what you've learned. Understanding cycle positioning. The elements that contribute to a surging market present themselves via valuation metrics such as P/E ratios on stocks, yields on bonds, capitalization ratios on real estate, and cash flow multiples on buyouts. These become extremely high relative to historical norms during market surges. And it is at these times that investments are positioned for low returns. The opposite is true when a market collapses, taking investment prices to bargain lows. Such an investment environment is ideal for obtaining excellent opportunities at discounts. Bull market cycle. Bear market. Golden opportunities. Bona fide bear markets provide the absolute best opportunity for shopping in the market. While everyone else is panicking, these are actually excellent opportunities to invest money. These opportunities are also readily identifiable because the media will announce that we are in a bear market. Consequently, there will be declines across the board in the stocks of various companies. Having already identified several companies with durable competitive advantage, their stocks will be ripe for the picking. As legendary investor Peter Lynch said, "You get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready." The secret is to be fearless when others are running for the exit. A bear market is one of the best ways to make money. Have your investment capital already in place and your investment options already lined up. Companies will be selling at a fraction of their long-term worth, and that's the best time to buy. Buying opportunities created by a bear market will ultimately be vindicated with big returns during the bull market that eventually follows. The Fed will lower interest rates to stimulate the economy and make corporate earnings more valuable. This is what causes the start of the bull market, where investors will see stock prices rise to provide spectacular results. Bull markets. During bull markets, we see excessive valuations. P/E ratios that were once in the single digits begin to climb to high double digits. When the market begins to suggest that earnings no longer matter and valuations are instead based on sales and revenues, that's a sure sign that we're in an overheated bull market. Even unprofitable businesses see their valuations soar in this type of environment. Unreal expectations for constant growth also become the mainstay. Obviously, such circumstances are unsustainable. Consequently, it's imperative not to get caught up in the market hype and instead be diligent for the coming burst of the bubble. Market corrections. During strong market periods, like now, there's a chance for the stock market to take a step back. This often leads to people selling stocks in a rush because they're worried. It's happening particularly in the tech industry today, but these dips in the market can actually be good times to invest. The basic parts of companies, like how much money they make, usually stay the same during these times. So, when stock prices drop, it's not because the companies are doing badly. It's more like a sale where you can buy stocks at a lower price. If you've already invested, it might also be a good moment to buy more. These dips aren't usually caused by big problems in the companies or the economy. They're often just temporary issues that make stocks cheaper than they should be, so they can actually be great opportunities to invest your money. Conclusion: invest wisely by focusing on market cycles and seizing opportunities, especially during bear markets and corrections. Prioritize value over speculation, ensuring a margin of safety in your investment decisions. The stock market's short-term fluctuations often offer great buying chances repeatedly. Don't miss out on more helpful tips. Stay tuned for more investing insights. Like, share, and subscribe for updates. Raise your investor IQ with cutting-edge info, insight, and analysis. Visit and subscribe for free at the link below.